Welcome to SharkCap Table. This is the tutorial dealing with PMVM, pre-money valuation methodologies. Okay, so you can read a little bit about it here. We have a button which is this tutorial, and what we're trying to do is we're trying to get an average of 4 different methodologies. Now the green method will go into detail, but I want you to think what's going to happen is we're going to do 4 different methods: the SharkCap Table founder valuation, the venture capital method, the Dave Burkus method, the risk factor summation method, and these will reflect here. If we did the scorecard method or bill paying method, we'd have to have localized data. We don't have any of that, but in case you get a hold of some, you can actually enter that number right there. Now, we also have an area here for the average angel pre-money valuation. I'm going to type into it $2.5 million, because that's approximately what the average pre-money value of an angel deal is going for in 2014. Now what's going to happen is we're going to take an average of the 4 black numbers here plus the methodology and the average of the pre-money valuation for angels, and we'll come up with a total of the averages. Now let's actually get into what goes on. But this average, by the way, will come over to home, and it will be reflected right here. Right here. You need to be logged in order to see this. And this is just going to give you an example of where you would set your pre-money value. We'd probably have to go, in this case, up to 5 million, and then we'd set it at approximately, and I'm going to use the arrow keys, there, $2.25 million. So that's the idea. We're going to work off of a pre-money value average. That's the average PMVM. And there it is, and you would just duplicate it or get it close. So now let's go back to PMVM. Welcome to SharkCap Table. We're going to discuss the PMVM tab, which is pre-money valuation methodologies. So we're going to scroll down. This white box basically tells you what to do and gives you the button to access this particular video. Now, we've got the green method, which is the SharkCap Table founder valuation. If we click up here, we can then reset it. And if we click on any of the black headings, let me move this up, you'll see that we actually have some help. Any of the black headings will give you help, and unfortunately it's slightly out of range here, so I have to move it. So okay, we're going to put in some cash. Maybe we put in $100,000. The size of the beta test, we've had maybe $65,000. Trade secrets, maybe we got $100,000. Pending patents, none. Proprietary processes, sure. How about $130,000? Software, yeah. $275,000. Now I'm rather glib with these valuations. You should sit there and think carefully about what these are actually worth. But you can see that there are a lot of categories. Value of the management expertise. Well, we've got a president. It's not the salary he made. If he made $300,000 and piloted a company to a $20 million sale, I've got to be thinking that that man is worth $1 million or more. But let's put in here for the president $200,000 worth of value. There we go. And a vice president maybe 125, 130, so forth and so on. I'm just going to continue to come down here quickly. Market size and capture meaningful share. Well, this is kind of nebulous, but it's difficult. You could have $1 million valuation just because you could be first in a small company with a big idea, but let's give it $200,000. Value of intangibles. Now here is where we can actually click on the other. I'm going to move this up so you can see it. We can actually name it whatever you want. I'm going to say brother-in-law relationship. There's always one of those brother-in-laws out there. I'm going to capitalize the R, and I think I'm going to brother-in-law. That looks like it's spelled correctly. We're going to save it. So now we have the brother-in-law relationship, and I'm going to say that that's worth $1 million. And there's 2 more that we could enter. I'll just leave them. So basically we now have a $2.2 million SharkCap Table valuation, and you can see that that number is right here for the first line. Now we're going to go down, we're going to do the venture capital method. This is a backwards method, meaning what happens is the investors want to get a 10 times their cash investment, and from the home page we have $5 million of investment. From the home page we have a $20 million exit value. So what we're really trying to find out is how much would they pay for pre-money value. Well, we're going to put the $5 million in. We're going to put the $20 million in. I'm going to ooch it back a little bit here to get it just right. Okay. And then if they want a 10 times, they got a -3. So something's dramatically wrong here. It's the fact that they have to put up too much money. But we'll just leave it as it is. There's a -3 million. That's a big hit. Now we're going to come down here to the Dave Burkus method, which is very similar to the Green method, and where you're going to enter some numbers, management expertise, and sound ideas. And don't forget, we've got help. You know, there's the help again. Tell you what to do, how to do it, some thoughts. So we'll just put some numbers in here just so you can see what goes on. These are not necessarily what these are really worth, but there we go. So now we have a $3 million Dave Burkus method, and just to prove it, you'll see it right in the yellow. See, there we got the 3. Now these two are going to cancel each other out. That's okay. Now we're going to come down here to the risk factor method. And the risk factor method is about 11 components. And again, you can find out what these are about. But the whole idea is that we have a -2 to a +2 scale. If something like management ranks high, it means it's going to help get a very positive, great exit price. And if you had bad management, God forbid, you'd put a -2 in there. I mean, who the heck would get started with bad management? But nonetheless, we'll put a 2 in there. And we're not going to be able to see all of them because of the limit of space, but we've got stage of the business. Well, I'm going to put a -1 in because we really haven't gotten started. Legislation, political risk, there isn't any, so I'm going to give it a 2. Manufacturing risk, there's not much, so I'm going to put a 1. For example, this legislative political risk, let's say you were going to open up some kind of a marijuana growing operation in a state that had not yet passed the legality of it. You could be in business or out of business with the stroke of the legislation pen, or legislative pen as the case may be. Sales and marketing risk, well, there's always some, but we've got that covered. Funding capital risk, et cetera, et cetera. So basically what happens, we're going to come down here, put some numbers in, and blah, 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 and presto, we're going to multiply, this is the sum, the net sum, we're going to multiply that by 250, and unfortunately you can't see this, but it says $3 million. I'll show you, there you go, see, risk factor summation method, 3 million. Now, we're going to take this number out of here because that's not $11. So here we have a net of 2.2 million. I'm going to move this a little bit more so we can see it. So we have the net effect of 2.2 million. We have the average angel. When you add these two together, go over to the home and see there's the 2.372 million. So we would then go in here and make it, I think we're going to have to change here the max. We're going to have to go to 5 million. And we'll come down here and 2.372. Well, that's about as good as we're going to get. That's pretty darn close. And there's our deal. And that's what pre-money valuation is all about. It's trying to give you some components to argue the point, rather than just saying, oh, guys, I think, Mr. Investor, that we're worth, 3.125 million. Well, how do you argue that case? You got to give them point by point. That's why you go back to pre-money value methodology. And you say, listen, we put $100,000 worth of cash. That's not chicken feed. We've already had a small revenue of beta tests, and that's important. A lot of startups have no revenue beta tests. Trade secrets, well, we got some really cool stuff. Sign that NDA and we'll tell you about it. We don't have any pending patents, but we do have proprietary processes, so forth and so on. And it's much easier to base an argument on a series of smaller valuations than just to have $3 or $4 million staring at the face. It's too easy for the investors to move that slider to the left and whack off $2 million just like that. Make it a little tougher for them. Argue the point in a nice way. So there it is. It's very simple, and I hope it helps you raise some money and maintain your pre-money value.